Bitcoin ETFs pull in $2.44 billion in a single month, the strongest institutional inflow number since October 2025. Goldman Sachs is buying. Fidelity is buying. The headlines are bullish. The narrative is clean. Institutional adoption is real, it is accelerating, and the smart money is finally all in on Bitcoin. Except it isn't. Because buried inside the derivatives data, in a number that almost no mainstream crypto coverage bothered to explain, the same institutions buying spot Bitcoin through ETFs were simultaneously opening short positions in the futures market. At scale. Quietly. Deliberately. And if you do not understand why, you are reading the ETF inflow number completely wrong. Before anything else, nothing in this video is financial advice. Bitcoin is one of the most volatile assets on Earth. This is market structure forensics. What you do with it is entirely your own decision. Picture a chess player moving a piece forward with their right hand while setting a trap with their left. That is the visual. The ETF buy is the piece moving forward. The future short is the trap being set. Both moves belong to the same player. Both are rational. And understanding why they coexist changes everything about how you interpret the current price action. Here is the mechanism. When an institution buys spot Bitcoin through an ETF, they take direct exposure to the asset. Price goes up, they profit. Price goes down, they lose. Clean, simple, directional. But certain institutional funds, particularly those running what is called a basis trade or carry trade, do not want directional exposure. They want the spread. The difference between the spot price and the futures price. They buy spot. They short futures. They lock in the gap between the two prices as risk-free yield, regardless of which direction Bitcoin moves. The position is market neutral by design. This is not speculation. This is yield harvesting. And in April 2026, that spread was wide enough to make the trade extremely attractive for institutional capital that cannot justify pure directional Bitcoin risk to its compliance department, but can absolutely justify a structured arbitrage position with a predictable, calculable return. The data confirms the structure with uncomfortable precision. Bitcoin's 30-day trailing funding rate on Binance reached -5% in late April, against a historical norm of positive 8%. That is a 13 percentage point deviation from baseline. BTC's long-short ratio showed 52.5% shorts versus 47.5% longs, a rare short majority for Bitcoin specifically. Meanwhile, ETH showed 67.6% longs, SOL showed 75.1% longs, XRP showed 70.9% longs. Every major altcoin was positioned long in futures. Bitcoin alone was net short. The divergence is not noise. It is the trading operating at scale inside the Bitcoin market while leaving every other asset untouched. They resolve through short squeezes. When the shorts become overcrowded, when the basis trade becomes consensus, when every institution running the same carry trade is positioned identically, all it takes is a price move in the wrong force covering. Shorts cover by buying. Buying accelerates the move. The squeeze feeds itself. Whale wallets holding 1,000 or more Bitcoin grew by 142 addresses over 6 months to reach 2,028 total as of May 2026. Large holders are accumulating, not distributing. Glassnode's RHODL ratio sits at 4.5, the third highest reading in Bitcoin's history. Readings occurred at the 2015 cycle bottom and the 2022 cycle bottom. But $2.44 billion went into ETFs. And the institutions running that money were short futures at the same time. And setups, historically, resolve in only